Welcome to Risk, Return, and Capital, Part 2. I'm going to share with you the risk level classification I use for myself and the accounts I manage. It's based on capital allocation per one S&P E-mini futures contract or a unit of risk. So allocating $500 per one contract with 100 to 1 leverage is what I call ultra aggressive risk level, which is really unacceptable for professional traders because it reduces trading to gambling. Allocating $5,000 per contract with 10 to 1 leverage is aggressive risk level. And Chicago Mercantile Exchange allows this margin for overnight risk, so why not to consider this as a benchmark for maximum risk taken. Also, it can be the only solution for those who are undercapitalized. Now, allocating 10 grand per contract using 5 to 1 leverage is a moderate risk level. And this is my personal favorite. I used to trade my own account and the accounts of my clients. And by the way, it's the 5 to 1 leverage ratio here is similar to 5 to 1 leverage ratio widely accepted in mortgage lending when buyers are required to put up 20% of the house price as a down payment. Allocating 30 grand per contract is a conservative risk level, and allocating 50 and more per contract is ultra conservative risk level in my classification, and it uses no leverage at all. Now, do you remember these two guys, Slow Dexter and Fast Joe from part 1? Where they're going to fit here in our risk level classification? Well, Joe was going to be here, aggressive level, and Dexter will be here, actually on the border of conservative and ultra conservative. And since Joe takes 10 times more risk than Dexter, he trades 10 contracts versus 1. And that's why his overall return is 10 times higher than Dexter's. Now here's a question for you. How many contracts would I buy if I had 50 grand? And yeah, I'm gonna be somewhere here, right? So the answer is 5 contracts, allocating 10,000 per contract, and using 5 to 1 leverage. All right, let's add Abner, another trader, to the mix. By the way, this name is listed as the least popular boy name at one of the internet sites. It means the light in heaven in Hebrew, in case you're wondering. So Abner has some dough to invest, about $500,000. But he's heard on the TV that futures are risky. So obviously, if you hear something on TV, it must be true. So Abner decides to play conservatively, to be totally risk averse. In fact, he chooses to be super ultra conservative and allocates all his capital, that is all his $500,000, to trade only one contract in E-mini futures. Now let's see how willingness to take risk influences the total return in terms of percentage for all 3 guys. We're going to make some assumptions here in this comparison. First of all, traders make the same trades, and traders make 1 point a day, which is equivalent to $50 per contract. The only difference in the trading would be, the different risk level. Now, you may ask, why should we assume one point a day profit? Well, over the years of watching the market and experimenting with different strategies, I believe that 1 point a day in S&P mini futures markets represent a realistic profit goal for quality traders. 1 point a day represent a very small move of the total market's daily fluctuations. So to paraphrase a popular saying, 1 point a day makes the trader healthy, wealthy, and wise. Which means that with the proper risk taken, this 1 point presents $1 billion opportunity for a trader. So let's take a look at the aggressive Joe who uses a 10-to-1 leverage. So he's making $50 a day, $1,000 monthly, and annually it's 12 grand. Which this 12,000 represent 240% return per one contract. Now, this slow Dexter with conservative risk-taking level would allocate $50,000 per contract, right? $50,000 per contract, using 1-to-1 leverage. So basically, using no leverage at all. But still, with 1 point, he'll make about 24% a year. And finally, Abner, our super ultra conservative risk taker, allocates all his $500,000 per contract using 0.1-to-1 leverage. And in this case, he'll make only 2.4% on his capital. So look again at this comparison table. Just because Joe was willing to take more risks, that is to trade more contracts, he outperforms his buddies Dexter and Abner. So 240% Joe makes, and Abner only 2.4%, and Dexter 24%. So in terms of monetary return, Joe makes 120 grand, Dexter 12, and Abner also 12. So the question is, what is going to be for you? Is it going to be 240% return per year or 2.4? Are you going to be aggressive or ultra conservative trader? So I guess at this point you are kind of tempted to use leverage to maximum. Why not to load cars? Cars is SME jargon for contracts, and try to reach financial freedom as soon as possible, but not too fast. There is a problem here, which is you're running a risk of ruin. When you play betting games like blackjack or investing, there's such a thing as a risk of ruin. Even if you have a winning system, say you're 70% right in your prediction, you still run a risk of ruin due to a series of losses. So let's say you have 2, 3, 4 series in a row, and take lots of leverage. You may run out of capital before you realize the advantages of your winning system. That's why every trader should be familiar with the Kelly criterion, which is a risk management strategy used in betting games. This criterion was developed by John Kelly in 1956. John Kelly was a physics researcher at Bell's Lab in Murray Hills, New Jersey. In his paper published in 1956, he explained how much should a bettor wager if he does not want to risk financial ruin. At the bottom, Kelly taught risk management is about avoiding the mistake of betting too much so that you can lose it all. And we'll talk more about the risk of ruin in our lessons on system development. To sum up, a return is a function of capital and leverage applied. Your return depends on the risk you want to take, or on the number of units of risk contracts in futures lingo you're willing to buy or sell. You can be a decent trader capturing at least 1 point a day, but show a mediocre performance due to insufficient risk taking or inefficient use of capital. And finally, risk of ruin limits return of any trading system. And every trader should design his own formula that would allow exponential growth of his money while at the same time avoiding the curse of gambler's ruin.